Welcome to Real Estate and Taxes with Lakshay, where we help you minimize your taxes. Welcome once again. Good afternoon to our Tuesday 2 p.m. session. Thank you once again. Thank you for joining today. Today's topic is PREC and tax savings for 2023. So the agenda for today we'll be talking about the PREC, its conditions and obligation, the tax savings that you can enjoy with PREC, the tracking of income and expenses in 2023. It's a new year. I'm going to be sharing a template where you can, identify all of your income and expenses so you are up to date on a month-to-month and quarterly basis. And number 4, the most important part of today's presentation is strategies to take out money that is already sitting in the PREC. So let's get started. First of all, why do we want to open a PREC? The simple and the most simplistic reason is for tax deferral opportunities. For example, if I own a corporation and I earn $500,000 of income, for that $500,000 of income, I'm only liable to pay 4.2% tax rate. Yes, you heard it right. For first $500,000 of income, you are only supposed to pay taxes of 4.2%. Whereas if you were to operate under sole proprietor, as your income increases, you pay more and more taxes. Most of the realtors range around the 100K mark, and around the 100K mark, it really becomes not favorable to operate under a sole proprietor because the tax rate is 37 to 43% taxes. So it's a very good idea to kind of explore this and think in that direction that if you haven't opened a PREC right now, 2023 might be your year. I know 2022 was a slower year for a lot of the realtors as well as real estate brokerages, but 2023, I think things will get better. And you can actually, by the second half of the year, you should see a lot of your pipeline ready to buy after the, interest rate hikes have been kind of paused. So something to think about. If you want to enjoy lower taxes, PREC is the way. So a lot of you are new. So I just wanted to tell you, if you want to open a PREC, what are some of the obligations and what are some of the conditions? The first and foremost, PREC has to be a provincial corporation. By PREC, I mean personal real estate corporation. Just like any corporation, you have the voting shareholders and you have the non-voting shareholders. The equity voting shareholder has to be a real estate agent or a broker or a salesperson who has a license. They must be the controlling shareholder as well, majority shareholder, and they must be the sole director of the corporation. For other businesses where we are running a trucking corporation, an IT corporation, or any other sort of corporation outside of real estate, the conditions are not so strict. You don't have RICO compliance rules to follow, so you can have your wife as the director, your children as the director. But for PREC, it is very specific. You must have only and only yourself, which is the realtor, as the director of the corporation. You cannot have your children. If you want to involve your children and wife in your corporation, you can issue non-voting shareholder and you can basically make them a preferred shareholder of the corporation and have them part of the corporation. Otherwise, from the other side, you are not able to add them as a director and you won't be able to have them as any of the equity shareholders on the corporation. So preferred shareholders, non-voting is the option to kind of basically have them on the corporation. So here's a quick example of how you can basically save some taxes. So if you are a sole proprietor agent, which is earning $200,000 of income after some expenses of advertising, rent, and utilities, you are basically paying taxes on $145,000 of net income, which lands you into 43% taxes. If you are a PREC owner, you have the same level of income, same level of expenses, you can see your tax liability is far higher. Why? Because under the PREC, your tax liability is actually lower. Because $100,000 of income, you pay 12.2% taxes, which is $12,200. And on the salary, if you were to withdraw $45,000 to pay yourself, you would pay taxes of $10,000 only. So $10,000 plus 12.2, your total taxes paid will be $23,000, which is still lower than if you were to operate under sole proprietor agent model. So PREC, you can easily see there's a tax savings if you were earning a higher amount, which is $200,000. As you make more money with PREC, you start to save more and more in taxes. So now that they're with an example, with the numbers, you understand what is the real difference between sole proprietor agent and a PREC. Let's get into something called tracking income and expenses for 2023. A lot of you guys are realtors who have advertising, commission rebates, and various types of expenses that you need to track throughout the year. I have prepared an Excel that you can email me and basically find out, and I can share with you is this will be a good guide for you in order to track your income and expenses. Whatever income comes goes into the top line, and whatever the expenses you make for meals and entertainment, advertisement, fuel, rent, interest cost, all of these can be, even the TREB and RICO fees can be classified on this Excel sheet. So it's a very good tool in order to keep an eye out on your income and expenses. So at the end of the year, it doesn't become too cumbersome to, look through 12 months worth of bank statements, look through 12 months of credit card statement. You can simply use this to track all of the income and expenses and put it here, and it will basically simplify your life and your accountant's life even. Now that we understand what are the advantages of corporation, we also understand how we can track the income and expenses. I really wanted to explain what are the 3 different types of accounts that will come with the corporation. With corporation, you have 3 different accounts called payroll account, HST account, corporate taxes account. Payroll account is basically based on how much income you withdraw. If you withdraw 40,000, 30,000, 35,000, based on how much you withdraw from your corporation and pay yourself as a salary, that will be your payroll tax liability. If you have an HST account, you can basically work on 13% of whatever the total sales were. For example, you earned $100,000, your total sales based on that would be 13,000 would be the HST collected. So that would be the HST account, RT account. The third account is the RC account. RC account relates to corporate taxes, which is 12.2% on the first $500,000 of income. So just a quick brief overview. Whenever you open a corporation, you have 3 types of account: RP, RT, and RC. They're related to payroll, HST, and corporate taxes. And basically, this is something that is different than a sole proprietor where there wasn't corporate taxes and payroll account opened already. A major difference between a corporation and when you were operating under a sole proprietor is the tax filing deadlines. Usually, tax filing deadline is same for sole proprietor and PREC for HST purposes, which is 3 months after the year end. But for corporate tax purposes, you pick your own year end. So for my accounting practice, I picked July as a year end because, that is the least busy time for an accountant. And, we can prepare our taxes when it's the dead season. So you get to pick your own year end. And you can pick anytime you want. It has to be 12 months, but whatever you pick in the beginning will stay with you forever. So make sure to, be cautious whenever you pick your year end when you open a corporation. One of the bonus things I wanted to mention here was everyone has a CRA My account, but not a lot of people are aware of CRA My Business Account. It is actually the same thing as you would see on your My account, but better. On CRA My Business Account, you can see all of the tax liabilities for all of these 3 accounts, which is HST, payroll, and corporate taxes. The best part is the My Account ID and password and CRA My Business Account and ID and password. You don't have to create a new one. You can simply use the same ID and password that you had for My Account to use your CRA My Business Account because, they work the same. So if you haven't signed up yet, sign up for CRA My Business Account, enter your business account number, which is your business number, and it will start showing all of the tax history, your prior tax filing, as well as it will give you options to change your address, apply for new benefits related to, rent subsidy, wage subsidy, and, different types of things that your business might be eligible for. Now that we have understood that how PREC can save you some taxes and how you should be tracking income and expenses and how you can even link your CRA My account to your CRA My Business Account, I wanted to highlight some of the ways how you can take money out of the PREC. Previously, when you are a sole proprietor agent, you are getting money paid directly under your name. So if I'm a realtor, I get paid all of my commissions under my personal name, which goes into my personal account, and I keep swiping that towards my business expenses and start paying my mortgage with that and yada, yada, yada. Everything goes from one account. When you open a corporation, you are technically supposed to open a separate business account. When you open a separate business account, commission that was technically coming, all of it was coming under your name. Now it's actually coming under your corporation's name. Now you must be wondering what used to be coming directly to my account and I was able to use that money to pay my grocery bills, my personal expenses, my mortgages. Now all of that money is stuck under the PREC because all of the money is set. And whenever I pull money out of the corporation, I pay taxes. So how do I take money out of my corporation in the tax efficient manner? So I'll be discussing a few ways how you can basically navigate and take money out of your PREC. So let's assume you earned $200,000 of income and you need to pull out $150,000 in basically day-to-day expenses from your PREC and defer taxes on the $50,000 surplus money that you have earned. So how can you use PREC to your advantage? I would suggest first run a salary of maybe $60,000. On $60,000, you can run yourself a T4, and on that T4, you can pay yourself. If you have a spouse that is a homemaker who is not working and is helping you in your day-to-day MLS uploads, finding the listings, and various administrative duties, you can also give them a salary of $20,000, $25,000. And even if you have a children that is over the age of 18 that are helping you distribute flyers in the market, you can also give them a salary of $20,000, $10,000, $15,000. That will certainly, 60 plus 20,000 or for your wife is 80,000 plus another 10,000 for your kid could be 90,000, right? That's one of the ways to keep your tax liability lowest and, withdraw more money that you could have otherwise taken out. You can also pay yourself a dividend of $20,000. On salary, we all know it's kind of expensive. You have to pay CPP, you have to pay income taxes, but on dividend, those things are not there. You can simply pay yourself a dividend, which is as simple as writing yourself a check. So that's method number 2, where you can take another $20,000 out, which is lowest tax liability. So 90,000 was taken out by you, your family, in your salaries. 20,000 is taken out as dividend. Now you're sitting at a grand total of 110,000. But you needed more money. You needed $40,000 more. So how do you do that? You can take a shareholder loan from your corporation. You can basically do is out of the 150 that you needed, you've already taken a 110,000. Shareholder loan could be another $30,000 to $40,000. And this shareholder loan, you have to remember that if you take a loan out of your corporation as a shareholder, you need to pay this back within 1 year. That is the only trick. So if you take out $40,000 today, by the end of the following year, you will need to pay this back. If you want to keep the money and not pay it back, it would get added to your personal income for the following year. These are some of the ways that you can take money out from your PREC. And all of the accountants will tell you about this, and they know already about this, and they're pretty famous. Now let's get to some of the facts or some of the ways that are not so popular, but there are creative ways of taking money out of your corporation. So I had a person who had gone through a LASIK surgery, which costed him approximately $10,000. A lot of the realtors already know they don't have health insurance, right? They don't have the company paid health plan, which will pay for or reimburse them for these cosmetic surgeries like dentures or, LASIK. With a health savings account, you can actually use the money from the corporation and pay for your personal expenses. So that is one of the ways where you can take more money out of your corporation without paying any taxes, because health savings account allows you to do that. Talk to your insurance broker to maybe get you set up with this. There are some premiums that you have to pay in order to, get set up. But if you set up today, you can pull expensive from today to prior to 2 years. So even if you had a surgery 2 years, within the last 2 years, you can still use that expense item and take money out of your corporation. So another critical and good way to take money out of this. Another way of taking money out of the corporation is paying yourself some home office rent. So let's assume you are working from your home, just like myself right now. You can basically deduct the property taxes portion of it. You can proportionally deduct your utilities bill, your internet, your home phone, and things like that in order to, basically, I have, for example, 3,000 square foot house, 100 square foot is being used for home office. I can total up all the expenses and I can do 1/3 of all of the expenses, 100 square foot divided by 3,000. 1/3 of the expenses can be taken out from the corporation in order to pay myself for the home office expenses that I may have incurred. The other two ways are the ones that are more creative. So a lot of the time, you guys are realtors, you see some opportunities where, you can do some private lending and make some money. Some of the people need money for long term, some of the people need money for short term. When someone is looking for a short-term loan, this is a way where you can take money out of the corporation, $60,000, and then lend it to someone on interest. This is another way of taking money out of your PREC, giving it out for interest and earning passive income on it as well. So think about it, because it is another way. You might be getting calls right now because the market is bad, people are not able to close. This is a great time to start doing some private lending, and the interest rate right now I'm seeing are very, very high. I've seen people collect 13% plus 5% lending fee, which works out to 18%. So another way of making some money as well as taking money out of your PREC. The last but not the least is the director's life insurance. A lot of you already have insurances. You already have life insurance, whether it be term life insurance or a whole life insurance with your your insurance broker. A whole life insurance is something that can also be used to take money out of your PREC and use it to your advantage. What do I mean by using it to your advantage? Usually, whole life or any insurance is technically used for protecting and passing on wealth to your children, right? It's basically a death benefit and you only get it at death. Term life, it's for a specific term, but for whole life, things are a little bit different. With whole life, if you were to, let's assume you earn $75,000 of income, you basically decide how you want to spend that $75,000. You can either invest in real estate or you can buy a whole life insurance or term life to protect your kids and save tax bill. But what if I told you there's a better way of using insurance? My better way is basically with whole life insurance, you can basically buy, not only just protect your kids, which is the death benefit, and pass on to your children some tax-free money, but you can also borrow from the insurance policy and invest in real estate. In the first option, you were only investing in the real estate and passing it on to your children. In option number 2, when you involve a whole life insurance, you're not only just buying insurance and protecting your kid, you also have the option to borrow against your whole life insurance, which is borrow money and invest further, grow 2 assets, not just one. So that is a very cool way of, looking into this. And it is one of the ways which is very popular these days. So certainly, if you want to know a little bit more about this or you're still confused, you can reach out to me and I'll be more than happy to sit with you one-on-one. With this, it kind of wraps up my presentation. Thank you guys for joining in today.